Year 2024 has been an epic year for investors, mostly those who were concentrated on the technology sector or those who even bought the S&P 500, which is the broad companies that are publicly listed in the US that constitutes the top 500 companies that are in that index. Now, in this video, I'm going to share with you the market outlook on the year 2025. And I'm recording this video on 26 December, but just to be clear, it is extremely difficult to predict the market. But like I do when I'm driving, I like to look at both the back view mirror and also look at the front where I'm going. But at the end of the day, investing comes with a risk. So please make sure that whenever you invest, make sure you do your own due diligence. Now, in this video, the first thing that I'm going to share with you is that I'm going to share some opportunities, risks, and what to expect in 2025. Now, if you look at the performance in the equities market, and even if you look at gold and other asset classes, the market, in terms of the performance, it has been very, very bullish. Now, what that means is that it has been going up, usually at least more than 20%. If I look at the S&P 500 this year alone, it has gone by 27% up. The NASDAQ, which mostly constitutes the technology sector, if you are looking at companies such as Apple, Microsoft, Amazon, these companies have been propelling this index, which went up by 36%. That means if you had 100,000 that you had invested, you would have made another 36,000 if you sell now and realize that. So that is the power of investing. Now, a lot of people like to only look at one side of the coin. Investing does come with the risks, right? Where there's a possibility of profit, there's also a possibility of also losing money if you don't know what you are doing. The Dow Jones, which usually constitutes the industrial companies, you are looking at those companies in the US domestic market that are publicly listed and that constitute the industrial sector. It has been lagging if you look at the NASDAQ, semiconductor sector, or even the S&P 500, but still it retained 15%, which is way above the inflation level in the US. Bitcoin, for me, I am big on equities. That means I'm looking at individual stocks and other publicly listed companies, mostly in the US and Canada. Bitcoin, it went up by 117%. That means if you had 100,000 that you had invested at the beginning of the year, it will have gone up even more than double. But the challenge in investing is that it is extremely difficult to predict the future. So when I'm investing, I like to balance the risks and the potential upside. So this is something that I always emphasize. Now, when I look at the gold performance, it has gone up 26% year to date, which is almost like the S&P 500. But what I've observed since I started investing in 2020 is that mostly when there is chaos, there's sell-off in the market, in the equities market, mostly people rush to gold for safety, and some people, they go to cash and sometimes even buy US dollar. So you see that the index that tracks the US dollar relative to other currencies, I think it is as a ticker name of DXY, it usually goes up. This does not mean that it's always. Sometimes there may be exceptions depending on what's really going on in the market. Now, broadly, this was the environment in terms of the returns. But if I drill down to the specific sector levels, according to data from Yahoo Finance, you can see that the technology sector alone, it almost retained 40%. So those people who had invested in the technology sector, right, even buying the NASDAQ, right, like ETFs like QQQ, which tracks the top 100 uh, technology companies in the US that track the NASDAQ index, they could have made quite a lot of money, right? But sectors that also did well include the communication services. You can see here, right, on this chart as well, that communications sector, it was second, you can see that technology and also consumer sector utilities. Now, what I want you to pay attention to is there are some sectors like the healthcare, energy, and the basic materials that really lagged behind. What I've seen is that usually the stock market, if I'm looking at those publicly listed companies in those sectors, they tend to rotate to say sometimes the money gets out of that sector that has been overperforming to those sectors that have not been performing well. Now, a lot of people, they want to use the S&P 500 as the benchmark of returns. You can see clearly here, and this chart was from slickcharts.com. There are some years that we're actually in the red, right? But there are more years that the market, in the equities market, the S&P 500 has shown that it has been in the positive. You can see that there are some years, even after the Great Recession here, 1932, 33, you can see here, 33, it went up above 50%, right? So it means it's something that is possible. And I want you to pay attention to this. You can see that these trends, it shows that the S&P 500 or the equities market, it can return positive returns for even more than 1 year if you look at it historical, which begs the question to say 2023 it returned positive, the S&P 500, the equities. Last year, this year, 2024. Now, is it obvious that is going to be another bullish year in 2025? That's what I am also wondering. But usually, it's possible that it can go up, but you can see that at least it's almost 70% of the times here, 7 out of 10 times, right? If you look at the data sets, the S&P 500 has retained a positive return compared to those years when it has gone down. But how do people lose money now? Usually when market drops like this, you see here, this is about 40%. You see here in 1931, it dropped like over 40%. It means if you had 1 million, right, you will have almost 400,000 down. So a lot of people then they panic, right? And you see what happens here the next year, like in this case, it went up. But this is not to say this is what will happen. It's extremely difficult to predict the market. But I like to look at the past, like I'm driving, like I indicated. I also like to look at the outlook. That's why I'm producing this video. But let's see people, those who stayed invested in the market, those who invested in the NASDAQ, let's say QQQ, this is an ETF that is managed by Invesco, the fund. You will see that here, the SPY, which is managed by State Street Global Advisors, it has been going up. Like if you look at the 5 years, past 5 years, it has returned 86, 87%. And the NASDAQ has almost returned like 147%, which is epic. But the challenge is that, as you can see here in these data points, right, on these trends, there are moments when it really goes down, but overall, if you draw a trend line, it has been going up. Is this guaranteed in the future? There are no guarantees in the market. Now, when I look at this, I tend to wonder to say, look, what are some of the things that I should look at? I watched a video by Larry Williamson, who is a very interesting person in the sense that he has been using data to try and look at the trends in the market. And one of the key things that he mentioned, that when I look at the macroeconomic indicators, like for example here, if you look at the unemployment, it has been 4.2%, which indicates that the labor market, people are working. A lot of people, they are actually working, about 7.1 million in the US. Those are the people who were unemployed relative to those people who were looking for jobs, according to the US Bureau of Labor Statistics data. If I look at the geopolitical landscape, tensions have been waning. In other words, there has been like stability in the Middle East geopolitically. But the challenge is that things can happen anytime without warning. And that situation can possibly rapidly escalate into something that can really move the market in the downturn. So, what do I mean by that? It is very, very important to pay attention to what is really happening in the market. Now, the job numbers have been incredibly well, according to Focus. You look at 220 to 220 people were added monthly. If you look at the latest data from investing.com, that was this past week. I'm recording this on the 26th of December. If I look at inflation, inflation has been 2.5. If I look at the data, which means that it has been contained from the post-pandemic, post-epidemic, COVID epidemic years. Now, interest rates, the Fed in the US, they reduced the interest rates by 25 basis points, and they've been reducing the interest rates. Now, they did indicate that in the last December meeting, that they are looking at the balance of the risks and opportunities. So basically, there's a bit of uncertainty, especially with the incoming administration of Trump. These policies that they will implement the incoming administration, right? They have not been very, very clear in terms of the detail. So we will see the market is mostly forward-looking. In other words, I want to invest my money with the anticipation that I'm going to get a positive return. Now, if I look at the GDP, which is the goods and services that are produced geographically within the economy, right? In the US, it has been going up, right? Which is a good thing. Unlike if you look at in Canada, our economy has been contracting, if you look at the data from the latest quarter. However, it is something that we will see as we go into the 2025. Now, probably you might be wondering, where does this leave us at? For me, like I said, my expectation is that because a lot of people, they do what is tax harvesting in the US or even in Canada, the first quarter, and this comes with a lot of caveats, right? People might possibly sell off. Remember, I said possibly sell off to take some profits, and then that might possibly result in some drop in the market around January. But again, there could be a lot of factors depending on what even the incoming administration will say, right? And that can possibly move the market. And if that happens, usually the market, if it corrects, in other words, if it drops, let's say by 10%, right? Sometimes people may keep on for selling, and then this might be a wonderful opportunity for people to buy. If I look at the data from the past, usually the first year in the US for any administration has been shown to come up to result in positive gains in the stock market. Now, is this a guarantee? Nothing is guaranteed in the stock market. So, like I said, I like to balance the risks and the opportunities. But there are some concerns that I have in the market. For example, if I look at the historical data, there was Professor Sheila. He was a very incredible person, right? He's someone who is highly regarded in terms of understanding the dynamics in the market. He developed what is called the PE ratio, and basically is looking at the price to earnings ratio of the publicly listed companies. So this data, then if you look at historically, the Dow, historically, the average has been, let's say 21%, if you see here, right? But now if you look at this ratio, it has been around 39%. So that means potentially this means that a lot of companies in the market using this indicator by Professor Schiller are overvalued. And usually if they are overvaluation, stocks tend to drop to correct, in other words, to revert to the intrinsic valuation, because the market, according to some theories, usually there has to be a balance. If there are opportunities, like I said, right, undervalued companies, people tend to buy and then bid the price up to the point that they are overvalued, and then people sell and take profits. And usually these cycles continue. This is my observation. Now, this is something that for me, I'm a little bit paying attention to, but I like to believe that other indicators that I look at, if I look at the earnings for the companies that have been driving the S&P 500, these major indices, they've been doing very, very well. The earnings have been, they've been beating the earnings. If you look at Amazon, if you look at Microsoft and Palantir as well as an example, NVIDIA, they've been ripping the market up in terms of their performance. Now, what this means is it something that is justified? Well, for me, I am almost like 60% cash and my portfolio is hedged. What do I mean by that? I'm a little bit concerned with the valuation, current valuations, and that doesn't mean that there are no other sectors that are undervalued. Like I showed you, right? There are some sectors like healthcare that are currently undervalued. The real estate, it has been lagging, but with the interest rates being reduced, what that means is that there might be possibility of those sectors to actually bounce back. Again, nothing is guaranteed because the Federal Open Market Committee, if they start increasing interest rates, let's say the US deficit starts to increase, their inflation concerns, what that potentially would mean is that the US might see increases in interest rates, and that might increase the cost of borrowing. And what that means is that other companies might start to, there might be a drop in their valuation. Because, like I said, when I buy a share in a business, I am looking into the future, right? So if the cost of capital now gets higher, that has to be discounted. In other words, it has to be factored in the present value. So at the end of the day, my point at the end of the day, in my analysis and the way that I'm looking at the market right now, the market, there are some companies that are really overvalued, right? If you look at other companies such as Palantir and all these big tech, in my view, right? Their earnings, yes, some of them, they can justify their performance, but I am a little bit careful. So, like I said, in 2025, we will see how the market will perform, but I expect that all things equal, there might be some sell-offs at the beginning of the year, people taking some profits, but because of the high valuations and the potential volatilities from the political situation in the US, I might potentially find opportunities to actually buy and average into the ETFs that I like to own that track the S&P 500. And if I see other individual companies that will be dropping below my intrinsic valuation, that might be an opportunity for me to add more shares into those or even to open positions. That is what I think. And again, when you are investing, always do something that you are comfortable with. So thank you for this episode and for being with me. I hope to see you in the next video, but don't forget to subscribe and follow me on social media for more insights. And I hope you will have a very wonderful 2025. Thank you again for tuning in. Isaac Jonas tuning in, tuning out, actually.